investing in Africa. My name is Rory Ord, and I'm joined by my colleagues Basil Rafi in London and Helene Gossaert and John Shoshe here in Cape Town. So in today's session, I will give a quick reminder of the macro position of African markets, as we've set it out in our Bright Africa report that we issue each year. And this year we issued a couple of months back. But of course, investing in Africa is an evolving story, as it is in all markets. And the events of the last year, the fall in commodity prices, the slowdown in China, and the constant debates around US monetary policy have all had their impacts on Africa, and we'll talk to some of that. The overview that we'll be going through in a second will demonstrate some of the reasons behind the recent challenging market conditions experienced in Africa. And some of it might sound a bit negative, but I think the intention here is to identify and isolate the reasons for the recent market challenges so that we can properly address these things and properly consider them in the way that we invest in the continent. But we don't want to spend too much time in the macro position because obviously we don't invest in GDP, we invest in companies. So what we should really want to hear about is the panel's thoughts on how institutional investors should be thinking about all this as part of their investment strategy for Africa and their investment strategy for the global investments. We'll be getting a lot of detail about Africa's listed markets, Africa's private equity markets and what they have to offer, covering some of the risks, and also finishing off with some of the practical considerations of choosing listed and private equity managers in Africa. Throughout the session today, we encourage you to send in your questions. Send any questions that might occur to you during the progress of today's webcast, and if we can't fit these in during the different parts that the panelists will be talking to, we'll cover some of them at the end of the session. So we'd first like to start with a quick reminder of what African economies are all about. So it's tempting to think of African economies as only commodity producers. And while this is an extremely important part of what many economies do, from a domestic perspective, these economies are actually fairly well diversified. And what this chart's showing is that in many ways there are some very strong similarities in African economies to more developed economies around the world. If we can look at the two bars on the left of the chart, those are the US and Germany, and it shows the GDP breakdown, or the GDP makeup of these economies. And we compare that to Africa, which are all the bars to the right of those. And we can see that actually, apart from the orange and gray blocks at the top of these charts, the actual makeup of these economies is very, very similar to domestic markets. Now, the gray parts are the extractive and agri parts of these economies, but otherwise, African economies are very, very similar to other markets around the world. But of course, economies in Africa are quite reliant on extractives, particularly from an export perspective. And this is what our next slide is showing. This is, of course, not a uniform thing. We know from some economies are much more focused on the export of extractives than others. These particularly include Nigeria, Southern Africa, Central Africa, and the Maghreb region. So countries with more exposure to extractive industries have done pretty well over the past decade, as commodity prices have been at historically high levels. But as prices have fallen in recent times, we've experienced the other side of this coin, that it's quite difficult once you've started to rely on high commodity prices for economies to adapt once that changes. So Nigeria's reliance on oil, for example, has been quite well documented, and it's the most obvious example, but many other parts of the continent also have significant exposures to commodities. And the way that this is impacted on economies with significant exposure to commodities has been, first of all, pressure on the currency, which must find a new demand-supply equilibrium as the value of exports fall. And then this has been followed by the impact on government revenues as royalties from the sale of commodities fall, which then has a significant impact on those states' ability to fund their commitments and balance their budgets. And we're still seeing the impact of these lower commodity prices roll through the various African economies. And this, of course, does have a local impact as it reduces local spending power and access to some imports. Encouragingly, the single largest category of imports into Africa is in the form of capital goods. And these are mostly coming from Western Europe, from Asia, and to a lesser extent from North America. And although more recent data was not available when we were compiling this, you'll see these numbers are actually from 2013, so it takes quite a long time for these numbers to come through. We suspect that the imports of capital goods will have decreased as new investment into the mining and oil and gas sector will have fallen over the last period of lower prices. As a result of the low levels of manufacturing activity in many countries, the imports of consumer goods as well as refined fuel remain large factors affecting the trade balance of local economies. And we're seeing that, that play out in some of the currency movements around the continent. So according to 2014 numbers, overall Africa's trade balance was marginally negative, but this has become somewhat more negative since the fall in commodity prices has come through. And so you'll notice that what we're showing in the chart here has actually changed a bit since we put these numbers through. For example, the chart that you see there, or the bar that you see there for Nigeria, will have significantly changed since these numbers actually came through in 2014. So this negative trade balance that the continent has is generally fine as long as the continent is attracting foreign direct investments to actually finance this trade deficit. But what we've experienced in more recent months and over the last year as a whole is that the slowdown in China and the uncertainty around US monetary policy has actually meant that global markets have become more risk averse and capital has been pulled out from some emerging markets and frontier markets, which has actually put quite a strain on domestic African currencies. What had also become apparent with the recent lower commodity prices and the dramatic decrease in the oil price is that certain countries and regions are very vulnerable to shocks from these commodity prices. We found that in particular Nigeria, Ghana, Zambia, and some other countries have experienced these very significant currency devaluations. In East Africa, while they're not as reliant on extractives, they have a very strong reliance on imports. So this reliance, as well as the impact of the decrease in tourism there, has exposed the region to trade deficits, and therefore there's been some currency weakness in East Africa, despite the fact that they're not actually reliant on extractives. Another interesting point to note is the larger role that remittances play in Nigeria, in Nigeria, Egypt, and Sudan, and the Maghreb region, as a source of foreign currency. And we find that the diaspora of people from these regions has resulted in significant money flows, which support local currencies. And the interesting thing about this is that over time, these have proven to be relatively consistent through the economic cycles, which gives these economies a nice, stable source of hard currency. What we've also seen is that in response to the foreign currency and fiscal shortfalls that we've seen in recent times, countries such as Ghana, Zambia, and Kenya have also raised US dollar-denominated debt in recent months to plug these holes. Another crucial component of the stability of African economies is the source of government funding. So in South Africa, the Maghreb, East Africa, and Francophone West Africa, there are relatively large tax bases, and these actually average at around 20% of GDP, which is a nice, stable source of income, crucial for accurate and reliable planning of these economies. And it's an enabler of long-term projects requiring multi-term commitments from governments. In contrast, Nigeria has a very small tax base at only around 3 or 4% of GDP, with the bulk of government revenues coming from oil royalties, which has made it a little bit more difficult for the government to find stable income over the last year. So in countries and regions with low tax bases, this results in a low level of consistent income, and consistent income is very important for the raising of capital through bonds for infrastructure projects, as well as to support the long-term maintenance that these infrastructure projects need. So the low level of government revenue in some economies has made it quite difficult for infrastructure development to go ahead, and has increased the focus on partnerships between public and private entities to develop infrastructure. So what this tells us is that governments cannot fund all of these kind of developments by themselves, and it brings in a real place for institutional investors to finance the growth of the continent. What has been quite interesting from our research in this area as well is to see that Africa's institutional assets through pension funds and insurance companies have been growing quite nicely, and we find that there's more than 600 billion in local domestic capital, much of which has been invested domestically. And while the bulk of these assets are South African, there's significant pools accumulating in Nigeria, Namibia, Kenya, Botswana, and other countries in retirement funds as well as in insurance companies. And there's very strong growth happening in both insurance and in pension fund asset accumulation across most markets in Africa. So what this chart is showing us is that there's, in global markets, there's quite a large allocation to equities. And that's even more so in the case of South Africa. There's a very strong, around a 70% allocation to equities. But when we look across the rest of the continent, there's much more reliance on investing into fixed income, and in particular into government bonds. So in Nigeria and East Africa, asset allocation is dominated by fixed income allocations. And when viewed alongside the high asset growth in these regions, this is illustrative of regulation as well as local investment opportunities. So local regulation remains one of the main drivers of asset allocation. So a lot of the investment regulations actually require a lot of domestic investment, and much of it actually points towards investment into fixed income rather than equities. But this is evolving over time, and we are seeing a relaxation of these investment rules. So we expect to see a bit more investment into listed and to private equity from most countries going forwards. So now that the quick recap of markets is done, we're going to turn our attention to the panel, and we're going to start with Faisal Rafi, who spends his days helping institutional investors to invest in the continent, and in particular helping them with their choices around asset classes and investment managers. So my first question to Faisal is, well, why do institutions invest in Africa? Why is it that they find it to be a viable part of their global allocations? Faisal.
Thanks, Rory. Generally, the reasons for investing in Africa, like any region or asset class, is one, for return, and secondly, for diversification purposes. Ultimately, the African continent, through its higher GDP growth, should return higher returns, and rightly so, because from a perspective of investing away from emerging markets in less liquid markets, you want a return premium in order to compensate for the less liquidity. So return is one thing, but that's generally a long-term investment. Long-term because in shorter term returns are volatile. And interestingly, this week I met many U.S. endowments, and generally everybody agreed that when one is investing in the African continent for returns, that's a long-term story, and capital needs to be patient. But more on a medium term and shorter term, the real benefit of investing in the African continent is diversification. The drivers of these African economies and the companies within them are very, very different in developed markets. And as a result, the return series can be very different to returns in developed markets and emerging markets, which are much more linked to developed markets these days, hence improving the efficiency of your return profile. And the reason behind it is the reasons for the growth in these economies are very, very different. They're very unique to these countries. Many of these countries are newer economies, and the reasons for their development is a very different drive and very independent to what's happening in the rest of the world. So from a positive perspective, these countries have the ability to create a positive return when other parts of the world are suffering. On the other aspect, obviously, is that you can also have situations where the rest of the world is doing really, really well, and the African continent suffers because of single specific risks happening in countries. For example, Kenya in 2007, when you had the political unrest in the country. So net, the diversification is far better. In terms of companies and investing in companies themselves, what we say is the risks are not higher, they're just different. So if you look at a private equity investing in a US company, typically to create the return, you've got to have financial leverage, there's got to be a lot of debt, and also and there's no kind of easy money. I mean, generally when you try to improve a company, it's got to take either innovation risk or it's going to have a very unique business plan that has not been tried before. In Africa, in contrast, you generally have very typical bricks and mortar type expansion. Generally, when you invest in a company, typical expansion plans are very simple. You're just building more shops, for example, and there is no other competition today, and there is no financial leverage. Obviously, African continent itself, though, has its unique set of risks that one has to worry about, the things that we kind of worry about on a daily basis, political unrest, corruption, things like those. So it kind of balances off improving the diversification profile.
So Faisal, thinking about those specific risks, currency risk is something that comes up frequently, and something that I've mentioned a couple of times today already. How should investors actually be thinking about managing their currency risk in Africa?
This is one of the greatest things of investing in the African continent. We just got to remember the African continent is not one country. It's 54 different countries with very different drivers of their economies, and they have very different drivers, which basically means that different things can be happening at any time. So this chart, for example, shows the relationship between currencies between African countries. And then relationship of currencies between other developing markets. The easy way to effectively look at this diagram is that the left part of this pyramid kind of shows that the relationship and correlation between currencies within Africa are very, very different. They're very, very low. There's no real pattern. Whereas if you look on the right of the chart, which is much more dominant on how emerging market currencies are linked to between themselves and developed markets, you see that the relationship is far more similar, i.e. they move in a similar direction. So the benefit is that you can have a diversified portfolio of companies or bonds in different countries in the African continent, and you can have offsetting trends. So, for example, as we know, the Nigerian naira has suffered a lot since the oil price has been reducing over the last year or so. So their currency has been dropping. But in contrast, Kenya, which is the other major economy in the continent in the eastern part, its currency has been benefiting because it's a net importer of oil. So the diversification benefits by investing across the continent are good. Your chart earlier, where you showed the spread of the drivers of the economies within those different regions, also showed something quite similar, that many of these economies have different drivers, which again is great from an investor's perspective, so that we don't have all our eggs in one basket.
Thanks, Faisal. The next difficulty or the next challenge that comes up in investing in Africa is around benchmarking. So when investors are looking at the continent and wanting to know, well, if I put some money in, how do I actually tell if I'm doing well relative to the rest of the market? Can you talk us through some of the difficulties and some of the issues around benchmarking in Africa?
Benchmarking in the African continent is difficult, or for that matter, in any frontier market where the illiquidity is high. So if we just remember the purpose of benchmarks, they're effectively developed. The way they have been defined, or what a benchmark should provide, is typically coming from a developed market perspective. And investability is a very important part of a benchmark. You know, the benchmark should be investable. One should be able to replicate it. The challenge is that an investable benchmark in the African continent would not tell us much. If we kind of use the same kind of rules that we use in developed markets or larger emerging markets, that kind of benchmark would really be unrepresentative of the continent. And as a result, what typically tends to happen is the different benchmark providers try to get around that problem in different ways. For example, some indices use companies that are listed in developed markets that have a lot of their business in the African continent. Other indices don't have that, but they have lower liquidity threshold. And as this table basically shows, is that the resulting returns of the indices can be very, very different. So what does that mean for us? When our clients invest in the African continent or the wider frontier markets, it's a long-term investment, understanding that liquidity is a challenge, and there is no right benchmark. We use a whole set of qualitative measures in addition to looking at these benchmarks, but one has to be much more holistic about it, and one has to tend to follow all the benchmarks and understanding, you know, how they are constructed and what their advantages and disadvantages are.
Thanks, Faisal. We're going to turn now to look at the listed equity markets in a bit more detail. And I'm going to bring in here one of our African listed market experts, John Shoshe. John, to start off with, we know that African markets are small, but can you tell us, when it comes to the market capitalization of African exchanges, how do they compare in terms of size?
Yeah, just to give you an idea of how the African exchanges are, you've got 28 exchanges on the African continent with just under 1,700 listings altogether. These listings total $1.16 trillion in market capitalization. Compared to the S&P 500, which sits at 18.5 trillion, you can see this is pretty low. And to compare it to your FTSE 100, which is 2.8 trillion, it's just under half of that. So 95% of this 1.1 trillion sits in the top 5 exchanges, which are made up of, obviously, the JSE in South Africa, with a market of $855 billion. And this alone is 85% of the top 5 of the market cap, of the top 5 market cap indices in Africa. It's obviously no surprise to see that Nigerian Stock Exchange comes in second at $79.5 billion. If you compare this to your South African one, it's under a tenth of what the South African market is. The third largest exchange by market cap is the Egyptian Stock Exchange at $57.53 billion. Then this followed by the Nairobi and Ghanaian Stock Exchanges at $19.2 and $16.4 billion respectively. In addition to the high concentration of the continent's market cap in the top 5 exchanges, the top 3 companies in each of these indices make up between 33 and 55% of the respective index market caps. So you can see from just that picture, we've got very small market cap in comparison to the entire, to the developed markets, and it's a very concentrated one.
Thanks, John. And we were hearing from Faisal a little bit earlier about benchmarking and indices, and we know that globally there's a lot of emphasis on investing into index trackers and things. But in Africa, is that applicable? I mean, is it how possible is it to invest into African indices?
There are a couple of indices on offer, and when you compare the investability ratio of these indices compared, for example, to the UK market, African indices are 54% investable, whereas the UK listed market is 85% investable. The indices on offer range from, out of all the indices, there's the S&P Access Africa, which will give you exposure to ex-Africa listed companies. So the makeup of this index is 32% South Africa, 31% UK, 22% Canada, and the rest being made up of the USA, France, and Australia. And they largely focus on materials and energy. Then you have two other types of indices which either focus on the South African market largely or the Nigerian market largely. So the ones which focus on the South African market are your S&P Pan Africa and your MSCI EFM Africa, which are made up of over 80% South African, with the other percentages being made up of the remaining African indices. But these are largely financial focused in the financial sector as well as the consumer discretionary sector. You then have your indices like your S&P Africa Frontier, your MSCI EFM XSA, and your MSCI FM Africa, which are largely Nigerian focused, as well as targeting the financial sectors and consumer staples. Just to give an added thing, I will also look at the liquidity of the indices in Africa. If I use turnover as an indicator of liquidity, the Johannesburg Stock Exchange once again leads with a turnover of 35.2%. Worryingly, the second index with the most liquidity is Egypt, and it only sits at 3.3%. Nigeria, which is in the top, which is the second largest market in Africa, is at the bottom of that top 5 at only 0.77%. As you can see, these are pretty low liquidity figures, and it can be attributed to company ownership traits in Africa, leading to a lower free float. So on one end of the spectrum, you have large multinationals that have a long-term invested view in these indices, and on the other end of the spectrum, you've got family-owned businesses where they're unwilling to relinquish ownership of the companies that they've built up over a long period of time.
So John, you mentioned that that investors looking at Africa will be able to see that, for example, financials, they can get quite clear access to financials in certain markets. But how should they go about thinking about accessing different sectors as a whole?
I guess you can see the developmental phase an economy is in by the sector accessibility in its equity market. With South Africa once again being the most developed in terms of infrastructure as well as having a significant middle class, you'll find that your information technology stocks, your healthcare, consumer discretionary are accessible through predominantly accessible through the JSE. There isn't that much really on the rest of the African continent. An interesting stock under consumer discretionary would be your SAB Miller, which made recent headlines in merger talks with AB InBev. Surprisingly, you also find that your industrials and telecoms are predominantly listed in South Africa. However, not overlooking Dangote Cement, which is listed on the Nigerian Stock Exchange, and Safaricom, which is a telecom listed on the Kenyan Stock Exchange, which make up significant market caps in those markets. Your utilities, consumer staples, and financials are accessible through a broader range of African markets, with the financial sector being split up between banks in South Africa, Nigeria, and Kenya. And real estate, which has been an interesting subsector of the financial sector, being accessible in South Africa, which is a sector that has been really doing well on the Johannesburg Stock Exchange. Maybe also as a function of how the African continent is seen, you'll find that exposure to energy materials can be gained through African companies listed in the UK, Canada, and the United States. Giving a couple of examples, you have Seplat Petroleum, your Nigerian company, and Suez Cement listed on the London Stock Exchange. Suez Cement is an Egyptian company. And you've got your Sasols and AngloGolds, which are cross-listed on the New York Stock Exchange.
Okay, so plenty to think about in terms of accessing different sectors and where these large companies representing different sectors can be accessed from. But what about how these sectors are actually priced in Africa, and how these different markets are priced? And we know that in recent times, with some of the withdrawal of some international capital from emerging markets as a whole, we've seen the performance slide in some African markets. But has this actually meant that there's buying opportunities, and what does it mean broadly from a pricing point of view?
Looking at price earnings compared to the S&P 500, the African markets are relatively cheaper, and I see this more as a function of liquidity, which causes the effect of inefficient price discovery. So in generally, you have underpriced assets, especially this past financial year with the Chinese as well as the oil crisis. You'll see that your most expensive markets, just to give a feel of how markets are priced in Africa, your JSE, it's more as a function of, it's the most liquid and accessible market on the African continent. And it has managed to attract your inflows from various quantitative easing programs from around the world. So all that money that was trying to get emerging market and African exposure was finding itself onto the South African market. And in addition, the South African market has got well-diversified companies which have cross-listings in more developed markets as well. However, an interesting case is your Ugandan Stock Exchange, which you would find to be a bit overpriced compared to your more liquid and upper-end markets in Africa. And this is more as a function of one particular stock shifting the price earnings of the entire exchange to one end. So on the whole, the pricing of African markets is based on the liquidity and the perceived risk of these markets. So you have, at a time when you were having your Chinese crisis as well as your oil crisis, there was African markets were seen as very risky, which drove the prices of the equities down, obviously pushing the price earnings as well down. So you can see this as a potential time to buy. However, if you're looking for your return in the domestic market firm.
Thanks, John. We're going to switch pace a little bit now from listed markets onto Africa's private equity market and listed markets in general. We're going to direct some questions to Helene Gossart, who focuses very strongly in this area. So my first question for Helene is, what does private equity look like in Africa? Is it something that global investors will be familiar with?
I think very much so. I think private equity looks very much the same as it does in the rest of the world, with funds being structured in a partnership tax-neutral way for investors. The normal terms is usually 10 years with a 2-year extension. And the management fees are normally 2% flat with a 20% profit share above a certain hurdle rate. For all of these things, obviously in Africa, as in a lot of other parts of the world, for private equity, there's been quite a bit of pressure on those numbers, and they are moving, ever moving, really. Another interesting fact about African private equity is that a lot of the large funds are pan-African funds, and as Faisal has said, in the end, Africa is still 54 different countries. So it takes a very large base of knowledge to invest all across the continent. So from the large funds point of view, they often have quite a lot of boots on the ground, and they cover a very large area. Some of the smaller funds are very much regional specific and country specific, with skilled teams that come particularly out of that environment. The other thing that's interesting, which I think Faisal might have alluded to as well, is that basically in Africa there's very little leverage on deals, and similarly in the funds there's not normally leveraging structured into the funds. So when we later look at these numbers, we'll see that that's one of the ways in which African private equity is a lot less risky than you would find in the rest of the world. What's also a bit different is that it's mostly growth capital, you don't really see venture capital in Africa. What you also don't see is a lot of LBO, MBO type deals. There's a bit of it in South Africa, but it's really very limited. It really mostly is growth capital. As Favor was saying, it's all about putting up another store. A lot of it's also about import substitution. So taking products which were previously imported and putting up some form of ability to produce those within a country. What's also interesting about private equity in Africa is it normally has a wider mandate than you would find for funds in other parts of the world. We have clients which within the same fund would invest in what would normally be venture tech, but would also be invested in IPP, which generates power. So they basically need to go where the opportunities are, so normally they have quite a wide mandate. As for jurisdictions, when you look at Africa, most of the funds run out of Mauritius actually, but some of them also run out of the Channel Islands. But all of these laws is pretty much what you get internationally in terms of trust law, in terms of trust law and company laws.
Thanks, Helena. And so really what we're saying is that private equity in Africa is a growth offering, and it's done in very, very similar ways to private equity globally. Has this offering been well received in terms of fundraising? Have these fund managers actually managed to raise money around the world?
Fundraising in Africa has been very good in the last couple of years. In 2013, 14, and in H1 2015, significant numbers of cash have been raised. In fact, there's been record numbers raised in the last, let's say, 8 to 9 months. Depending on how you count it, it's about 4 to 6 billion which has been raised in that period. A lot of that was raised by the top-end funds. So if you look at the biggest fund which has ever closed in Africa, it's Helios 3 fund, which is 1.1 billion. The Abrage fund, which is the Sub-Saharan Africa fund, is at 990 million. And then you also have Development Partners, which in their second fund raised 725 million. And then with the new kid on the block with a long track record elsewhere, Carlyle has raised almost a hair under 700 million. So those are significant numbers which make up a significant number of those fundraising, of the fundraising pool we were just talking about. On the lower end, it's more difficult to raise funds. I mean, I think partially because the guys lack track record, but also because of institutional needs, which we'll talk about in a moment. From a deal-making side, it's been slightly different in that there's been also record high deal-making opportunities in 2014. Depending on the source of where you get your data, it could be up to 8 billion. That's one of the things which is interesting about investing in Africa and also represents some risk, is that it's not always an information-rich environment. So you need to hunt around for your information, and you need to be sure that you trust the source and go and look at exactly what it is that you're looking at.
Thanks, Julian. And when we, much of the talk around fundraising around private equity in Africa and the raising of these very large funds in an African context, and the entry of some of the global players into managing funds in African private equity has meant that there's somewhat of a concentration of capital at the larger end. Has this actually led to a mismatch of supply and demand for these kind of deals?
It's an interesting question because the funds at the top end have been able to raise significant amounts of capital. The normal sort of sweet spot for deal size in Africa is normally estimated between about 10 million to 25 million US dollar ticket size. So looking at that, the implication is that the sweet spot for a fund is somewhere between 250 and 400 million USD. Now, some of these funds are significantly bigger than that, but keeping in mind that up to now they have been delivering the returns, and because of the wide network that these guys have, they've also been delivering proprietary deals as opposed to getting into a competitive bidding environment. The supply of Pan-African companies is reasonably limited. There's a couple of financial institutions which operate in more than one country, but in general you do not get large mega companies that operate across a number of markets. The other option which the guys have been looking at, which makes sense, because as John has been explaining, that the listed market is not really a liquid market towards the lower end. And if one looks at the type of assets which is listed there, they would normally fit within the gambit of private equity. So a lot of the guys have been looking in terms of investing some of the private equity money into some of the assets which may be listed, but not necessarily the large caps and the liquid stocks. When one looks at pricing, it's always interesting to look at the levels of debt that you see in Africa. When one looks at this graph, you'll see that the lines represent the global numbers and the bar graphs represent the African numbers. So the first thing that's interesting to note is that the debt in the global context is a lot higher. And when one looks at debt in Africa, especially on the lower end, it is almost negligible. On the higher end of the African deals is normally the energy stuff and also the large IT deals, especially around towers and those sort of things. So those guys have more access to capital, and as John was explaining, a lot of those guys get capital from other sources, just like the listed energy guys getting capital out of the UK and Canada. They also have more access to debt, which allows that. But in general, the debt levels are extremely low. And then if one looks at pricing, the pricing levels for African deals has been very similar really in EV/EBITDA towards the smaller end of deals. Towards the larger end, there's definitely, we've seen some upward pressure, but even looking at that, it's significantly lower than you're looking at on global levels.
Thanks, Helene. And where are we seeing these deals happening? I mean, a lot of the story and the narrative around investing in Africa is around the consumer side of things. Is this where we're seeing the deals, or is it a different story?
I think that if you look back over the period, I think the first thing that you've got to notice is the lumpiness of it. So it doesn't stay the same year on year, which is also an issue of a relatively small market where one or two bigger deals will skew it in a year versus another year. But I think what's quite important to notice is, as you were saying, if you look at the top of that graph, you'll see the orange bars, and just below that, the grey bars. And those represent staples in the consumer discretionary. And you'll see that, in general, they are some of the shining stars in terms of deals that are being made. You'll also see in 2014, interestingly enough, that there was a lot of energy deals being made. Obviously, at that point, the oil price was still quite high. And if one looks at the H1 numbers in 2015, that is obviously not the case. But what's interesting is then which other sectors has gotten a foot up in terms of getting an opportunity once the energy money is not flowing. It's interesting that things that are more past the initial spend of the middle class are starting to see attractiveness, something like healthcare, for instance. There's been an uptick in investment in healthcare. And then I think there's always the story around utilities and energy and infrastructure in Africa, which we'll touch on a bit later.
Yeah, so on that point on infrastructure, it's an interesting one because clearly Africa has a huge backlog in terms of infrastructure, but and we know that vast amounts of capital are needed to actually to correct this and get it up to standard with the rest of the world. Is this actually presenting an investment opportunity? I mean, is it being able to be packaged in that form?
Yeah, I think, as I said, as you said, the energy needs in Africa has been well documented. Some of the guys in the business once said to me, which I think is interesting, the sound of business in Nigeria is the sound of a diesel generator. And this has been very much the case. But the point is, electricity off a diesel generator costs 4 times what it costs out of the normal sources that you will get. So there's obviously, in order to allow these economies to get to their full potential, the governments need to provide some of the infrastructure. And very much, this is part of the African story, is that governments have been moving towards democracy and stability, and that they understand that they need to provide these things. So they, from their point of view, have been looking also to do this. But in terms of the African environment, infrastructure is still a very, very young asset class. In the past, it was very much the playing field of the DFIs, and now only is commercial investors coming in. And equally, there is still currency risk and political risk involved, which is one of the reasons why mega projects in Africa is unlikely. But similarly, as in the rest of the world, people find that there's a lot of problems with mega projects, and especially, as I said, in the African context, anything that goes cross-border means that you've got to take multiple currencies and multiple political risks into account, which starts making it, you're not able to close the project, you can't finance it. But what this has done in general, it has resulted in a big growth in IPPs, so in people who are generating power independently and selling it to the government, not just in South Africa, but in other parts of Africa as well. One of the flagship projects, for instance, is the Turkana project in Kenya, which was closed in last year and construction has started. And they believe that that is one of the best wind sources in the world, with something like a 63% capacity factor. As for one of the things which has enabled investment into Africa is the South African REAP program, where Eskom in South Africa has tendered out, not tendered out really, it was a competitive bidding process, the right to supply renewable energy to Eskom. And what has happened is that a huge amount of capital has flowed in from other parts of the world, and it has allowed for big investment opportunities, but also created expertise within South Africa, allowing them to venture north over the border and start looking at infrastructure opportunities further north.
Thanks, Helena. I want to bring it back to Faisal now. Now that we've covered some of the detail of the listed markets, the private equity and infrastructure opportunities that there are in the continent, and just bring it back to what it means for investors. So Faisal, what does this mean, all this information mean for your ability to choose managers and the way that you choose managers across asset classes in Africa?
Great. So we're running short of time, so I'm going to keep it short. In terms of choosing and selecting investment managers, given some of the challenges that John explained about, John and Helene explained about listed and public, there are some subtleties where you can't use the same kind of rules of researching emerging market equity managers or U.S. equity managers in the context of Africa. There typically tend to be two types, kind of HR related and kind of the ones related to the investment process. So basically with respect to the HR related issues, the big challenge is that these are new markets, you have scarcity of talent, you don't have existing track record, so one must be comfortable in researching and investing with emerging managers, which is more of a unique skill set. And you can also have some kind of weird kind of dynamic. So for example, in developed markets, when we invest in private equity markets, we typically expect that the fund 3 or 4 should be in a much better position in fund 1 and 2. But actually, in emerging markets and frontier markets, you can have a situation where fund 1 or 2 has the ability to deliver far better results than fund 3 or 4 because the guys are much more driven. And by the time fund 3 comes, your staff is at a risk to be poached by others and things like that. And then the other aspect is infrastructure. So these are capacity constrained markets, which basically means that you have less fees coming from as a percentage of your AUM. So the amount of money you have to set up your infrastructure in terms of the number of people you have can also be very limited. With respect to the process, these markets are very inefficient, and the subtleties and differences come at the start of the investment process, which is kind of sourcing the deals, and then at the end, which is implementation. In terms of sourcing, these are areas where information is still an advantage. Access is still an advantage. It can be hard to get hold of people you want to meet and getting information out. So when we research asset managers, we spend a lot of time in trying to work out how can they do that. And then when it comes to the implementation, John mentioned how illiquid these markets are. So very well said that I like this company, I've researched it, and it's cheap, so I want to buy it. But then actually implementing the trade, it becomes not that easy. You have to have unique ways of working out how you're going to get hold of the stock that you want to actually implement. So effectively, those are the kind of, in a summary of the subtleties you have to look at when researching asset managers investing in the African continent.
Thanks, Faisal. We've had a question from the audience around the risk management strategies that are used in Africa, and how these might compare to the way that risk is managed in portfolios in other parts of the world. Are there specific considerations and specific ways in which risk is managed in Africa from an institutional point of view?
Yeah, so there are a couple of things that far more attention is paid to them when researching African asset managers, whether they're private or public. Firstly, diversification. Diversification, that is just so crucial. Why? Because investing in a very specific country, you never ever know what could go wrong, and ultimately the only way to manage that risk is diversification. So that's the first aspect. Second aspect, corporate governance and ESG standards. People typically, when they invest with managers in those places, they spend a lot of time on those kind of issues. Actually, what it turns out is that because so much focus is on ESG, that typically the standard procedures are actually a lot better than some of the private equity companies you may find in mid-market Europe and US. And that's partly a function of the time that's spent on ESG. The other aspect is actually knowing, trying to understand the people that you're partnering with, how they actually, what their track record is of management during hard times. So a lot of attention is paid to that. I guess that's no different to researching an asset manager anywhere else. I mean, I could go on, but yes, the short answer is there are specific things that we spend far more time on when it comes to risk management.
Thanks, Faisal. And another follow-on question from the audience is around the appetite for US capital looking at Africa. And I know you mentioned earlier that you've spent some time this week, in fact, speaking with some US investors. So are you seeing that there's more appetite and actually more action from US investors?
Yes, it's happening. There's a lot more interest than action. So if you spend time and talk to people, you would think that the continent is going to get a bubble if all these people invest. But then when you speak to fund managers and you talk about fundraising environment, you actually see the reality is quite different. Helene kind of hinted to one of that issue, which is that actually the guys who have built up the infrastructure are getting a lot of assets, whereas a lot of the other asset managers are struggling to get off the ground. But generally, we see a lot of interest. The typical issue that always comes up is a lot of people interested. They actually don't know how to go about it, and that's one of the things that we're spending a lot of time with them. Everything starts with education first.
And Helene, from your perspective of working with private equity funds around the continent, are you seeing more investments coming in from abroad?
I think the experience is very similar to that of Faisal. There's definitely interest, but it's a slow process to deployment. And then also for the private equity funds, they check the ticket sizes that get written in the US from big institutional investors would basically drown the fund. And those guys really what they want is less than 20% of a particular fund. So from that point of view, it's difficult for them to sort of be accommodated within that framework. But what is quite interesting is that you're seeing a lot of of the US private equity firms moving over here, which most probably means that they will in the end have an African offering. So we've also seen some deal activity from KKR recently, which also brings another aspect to the landscape.
Thanks, Helene. Another question coming in from the audience is around, we've had a couple of questions actually around this point, on the political and sovereign risks and how those are changing over time. And I'll just have a stab at answering this quickly. Sovereign risk is an interesting one, and we can probably the best indicator that we can see on it is the prices at which US denominated bonds are being issued by local countries. And you know, over the last few years, we've seen quite an uptick in the number of dollar-denominated bond issues that come from African countries. And if you go back a couple of years, before the commodity prices fell, that was something that was a relatively cheap source of funding. We saw a lot of the sovereigns managing to issue in the 6 to 8% range in US dollars. What we've seen with the issues this year is that those yields on bonds at issue have been significantly higher and have been closer to the 10% mark and sometimes over 10%. So there's been a significant uptick and in addition to that, the levels of interest in those bond issues have also fallen. So whereas if you went back a few years, there would be multiple times oversubscribed, that is now no longer the case. So we can see that at least the market perception of sovereign risk has actually increased, at least for the commodity-based economies. All right, that actually takes us to the end of the time that we have for today. Just like to thank everyone for joining. Nice to see so many of you dialing in for this event and for your interest in Africa. And to thank the panelists. Thanks the panelists for their efforts and their contributions here today. And also to thank those of you who sent in your questions. Always appreciated. If there are any follow-up questions, you're more than welcome to get in touch with any of us and have a look at our Bright Africa report, which actually provides a lot more context to a lot of these issues. You can find that at riskero.com/BrightAfrica. Otherwise, we hope to do more of these webcasts in future, and we look forward to talking to you all further then. Thank you.
Thank you, Rory, Helene, Faisal, John, and thank you everyone for attending today's webinar, The Practical Implications of Investing in Africa. If you have any other questions, please contact us via the email address on screen. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate if you would complete that and provide your feedback. You will also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of Riskero and our presenters, thank you for joining us today and enjoy the rest of the day.